Hi, this is Matthew Cratter from Trader University. And today I obviously want to talk about the continuing stock market crash. We just had the worst day in stock market history since Black Monday back in 1987 when I was just 17 years old. So very few of us have ever seen a market like this. But I want to give you guys sort of a glass half full, rather hopeful take on this. But before I do that, I just want to say if you want to follow how I'm trading this market and my thoughts on the unfolding crisis and bear market, be sure to hit that subscribe button. So obviously terrible day, major indices down almost 10%, S&P 500, Dow, Russell down even more than that. And that brings us, the S&P 500 is now down 23% year to date. But let me go quickly to the hopeful point. But before I do that, the time to panic was a couple months ago. I was putting out these videos, 4 ways to protect yourself from a stock market crash 2020, February 17th. But now we're in a different situation. The VIX is at 75. The VIX is at 75. I think it went to 100 during the great financial crisis. But I don't believe that you can lose money investing in the US stock market if you invest in an index like SPY or QQQ when the VIX is at 75. And in the one case where you could lose money investing in this level at this level of VIX, it would be one of those apocalyptic scenarios where the last thing you'd be worrying about was your stock market portfolio. You'd have actual civil war, civil chaos, revolution, mass deaths. And I don't think we're going to get that in this situation. I think we're in for a difficult 12 to 18 months. But the good news about these viruses is that we know roughly how they behave. Now, coronavirus might be different, but I don't think it is based on all the science that I've been reading. So what generally happens is when the weather turns warmer, the virus becomes less active and much less dangerous. It kind of goes underground. So 4 to 6 weeks from now, much of the U.S. is going to be having much warmer weather. Now, the Southern Hemisphere is another story. Brazil, Australia, they're about to enter the winter season. So I'm sort of going to bracket that, and I'll talk about that now. But for the U.S., this virus is going to go underground during the summer. Now, the problem is it's going to come back probably stronger in the fall and winter. So you could have a bounce, but then the market's going to start pricing in a nasty fall and winter. This is what the Spanish flu did. But if we take a little bit more of a bird's eye view of that, this year is going to be very bad for people, for a lot of people, particularly the elderly, people with chronic diseases. So I certainly don't want to make light of any of this. There's going to be a lot of human tragedy. But if we take the bird's eye view of this, what happens with these viruses is they come, they wreak havoc. Most of the damage happens in the first year. They may come back the second year, a lot less damage. By the third year, they're basically, people have developed an immunity to it or unfortunately passed away. So this is one of those things where we can see sort of the light at the end of the tunnel. So what I would say is certainly if you have a 3, 5, 10, 20-year time horizon, you should not be panicking. You should not be selling. None of this is investment advice. Everyone has their own situation, so you got to consult with a personal financial advisor. But I think if you buy the SPY or the QQQ when the VIX is at 75 and you can afford to hold it for 5 years, you're going to make money on it, and you'll probably make a lot of money because the central banks of the world, especially the Fed, are not going to let this market stay down forever, particularly as all the baby boomers are retiring. They're going to do whatever they can to get the stock market back up to its highs. Unfortunately, by doing so, they're going to totally destroy the U.S. dollar. They're going to print money. They're going to send free checks to everyone. You're going to get your universal basic income checks. You're going to get your payroll tax cuts. But what can happen is the Fed, they can print money and go buy S&P 500 futures or ETFs. They can talk this market higher. And so if you have this long-term time horizon and you own a diversified basket of stocks like the SPY or the QQQ, I think you'll be fine. I think you'll actually do very well over the next 5 years. Now, in real purchasing terms, what's going to happen is that the stock market index is going to go up and the value of your dollars is going to go down. And so you might be sort of running in place. And this is why it's important to have something like gold, GLD, Bitcoin, which I'm going to talk about in a minute, or real estate, which will adjust. Stocks will adjust as well. There is sort of an inflation or money printing hedge in them. But I think very rare assets like coastal real estate, gold, Bitcoin, these sort of things, maybe collector cars, very rare coins. These sort of things will hold their purchasing power in this environment. So we're talking about if you're buying individual stocks, if you're buying Oxy, for example, if you're buying Ford, if you're buying some of these companies that could very well file for bankruptcy. I'm not saying you're going to be okay. If your company has a lot of debt and their revenue has just fallen off a cliff, like a shale producer, someone in the oil patch, or a highly levered industrial company, maybe a travel company, a highly levered airline, you're going to be in trouble. But eventually this is going to clear. Maybe some companies will drop out of the indices, new will be added. But I can guarantee you that SPY will be at new highs in a few years from now. Now, that is with the one proviso that the Earth doesn't get hit by a comet, or 50% of the population doesn't die of a pandemic. All these terrible things we could imagine. All of which is to say is not the time. Now is not the time to panic. There are great stocks on sale now. McDonald's, for example. McDonald's, Starbucks, Southwest Airlines, which is a really well-run airlines. They don't have a lot of debt either. It's a Warren Buffett name. Names like Apple, Amazon. Now, before you rush out and buy these, again, no investment recommendation here, these could go down another 30%. So if you're going to buy this SPY or the QQQ or buy one of these, be prepared for a drawdown. Know that you're in it for the long term. But if you already own these and you have a long-term time horizon, I think it's crazy to be selling right here. Right now, people are getting margin calls. Hedge funds are blowing up and getting redemption calls, and they're needing to sell their stocks, sell their bonds, sell their Bitcoin, sell their corporate bonds, just dump all this stuff in order to raise cash to return to their investors. Things have gotten so bad that the market dealers who deal with U.S. Treasuries, which are the safest instrument in the world, and as you know, I've been long IEF, or the equivalent of it, which is the 10-year note futures. This has just had a tremendous volatility, and we've had this weird situation where if you look at the TNX, which is the 10-year note yields have moved from 40 basis points up to 85 basis points. This is because there are a lot of institutional players who cannot get the funding in terms of the repo market, cannot borrow the money to buy these. So there's lots of really weird technical stuff happening. And as a result, I know a lot of you have been wanting to buy into this, not an investment recommendation. This is a perfect entry point, in my opinion, if you can consult with your financial advisor and if you believe that interest rates in the U.S. are going to zero. I think they're going to be at zero. I think the entire Treasury curve will be at zero probably by summer. And so there's just huge upside in these Treasuries. If you think interest rates are headed higher, permanently higher because of some inflationary shock, you shouldn't do this. But the Fed can buy these Treasuries, and once the financing situation gets resolved and the central banks provide enough repo money to fund these, that's the first thing you're going to see. Is you're going to see rates continue to fall. This is a technical thing that's happening. The same is with gold. Gold has basically a fixed supply. There's 62 years of inventory above the ground. It would take 62 years to replace it. And so you have a situation, this happened in 2008, where people were dumping the safest stocks. They were dumping gold. They were dumping everything. And simply because they needed to make room in their portfolio, they needed to raise cash to return to investors, they were getting margin calls, or they had cutbacks in their risk budget, their VAR budget. Basically, when you're an institutional investor, if something's very volatile, you can only hold so much of it. You have these risk management rules. And often, and I know this from when I was running my hedge fund, I was actively selling stocks out of my hedge fund while I was buying them in my personal account. Now, these were index funds. I wasn't like self-dealing or anything, but I was having to meet investor redemptions. and having to sell stocks in order to do that, even though when I knew stocks were undervalued. Now, this was early 2009. Stocks are not cheap yet. But if you have a long enough time horizon, and with the VIX at 75, I don't think you can do wrong with a long time horizon. Things like Disney, we talked about, Southwest Airlines, these kind of companies. So that brings us to, and of course, gold. So gold, the central banks are going to have to print a lot of money. It's the only thing they can do. They're going to print money. The government's going to spend a lot of money. There's going to be, people are going to get free money checks in the mail. There's going to be a lot of infrastructure spending. Maybe they'll start paying for our votes, like an Andrew Yang. So there's going to be a lot of money. It's going to devalue the dollar. It's going to devalue all fiat currencies, and gold will go up. Something very similar we've talked about happened in 2008 to 2009. Gold sold off as everyone was just dumping every asset. And then for the following years, as we got all this quantitative easing, gold went up quite a bit. Now, this brings us to Bitcoin. Bitcoin, there's some debate whether it was a safe hedge. Definitely not a safe hedge. This is the one position. I've traded this crisis quite well, except for Bitcoin. I've just gotten totally hammered in Bitcoin. My average cost is still below 10,000, but I really wish, Bitcoin was down 26% today, and some of the other cryptos were down 25 to 50%. I really wish I had waited on this one. This is a very small market. If we look at CoinMarketCap, and we can see that the entire value of Bitcoin is 107 billion. That's smaller than a lot of US corporations. And of course, this is after it's gone down by 25%. Here you can see Ethereum down 31%. Some of the other cryptos have gotten hit. Bitcoin Cash and Bitcoin SV, which are both garbage in my opinion, have gotten hit even harder. But Bitcoin itself is the real thing. It's a very volatile asset, as we all know. I never expected it to go this low. If I had expected this, I would not have been buying when it was 7,000, 8,000, 9,000, and 10,000. And so I'm sitting on a really big paper loss here. And it's very annoying and very painful as well. Again, I could be wrong about this. This thing could be headed to zero, but it is currently unhackable. It cannot be stopped by governments. It's the scarcest asset in the solar system. And so I think I'm going to be buying more of this. I'm just trying to get cash into my account. And I don't want to go to a bank and touch the door and touch their pens and everything to do a wire transfer. So there's a little bit of a delay. But I'm going to be buying more Bitcoin at these levels. Never thought we'd get down here. So I think it's a very exciting opportunity. This market is very easy to move. You just need a couple people dumping it. Maybe the big whales know something that I don't know. But I think we just had too many leveraged players in this, and it's being dumped in the same way that gold's being dumped, in the same way that treasuries are being dumped. This is just unbelievable in this environment where Europe has all these negative interest rates, Japan is negative, and we know that rates are going to have to be at least zero or very close to zero in the US. Treasuries should not be going down. So there are a lot of technical things happening in these markets, and that's why it's important. If you're trading stocks, it's good to trade with a stop loss. And that's what got me out of all my stocks earlier this year. We talked a little bit about that using the 50-day moving average, the 200-day moving average. If you have strict risk controls, you can control it. Something like Bitcoin, I do not have a stop loss simply because it's too volatile. And so one has to be very careful if you're gonna trade something without a stop loss. It's gonna have more it's gonna be more like an option where you're just risking the premium. And so I put a fixed amount that I and my family could afford to lose. I put it in Bitcoin. Right now I'm probably going to put some more in, which may or may not be wise. Time will tell. This is an asset I think is going to 100,000, 200,000. I think it's going above 1 million. I think it's going to a couple million this decade. I know that sounds completely crazy, but you have to understand, I had so many people tell me I was crazy in January and February of this year when I said the stock market has a very high chance of crashing. And I wasn't even that aware of the coronavirus, how serious it was, but I just knew we had an inverted yield curve, etc. So if you're going to be a successful trader and a successful investor, you got to make these really uncomfortable calls, and you have to think opposite to the crowd, especially at the turning points. When you've had an 11-year bull market and you get an inversion in the yield curve, this is extremely bearish, and it always plays out. It always plays out this way. That's why I warned all of you about the stock market crash. So the time to act was back then. Now the drawdown has happened. Maybe we go down another 20% or so. I don't think so. I don't think the Fed lets us go much lower. I think you're going to see just extreme measures. This has been a very strange bear market where it's been the fastest crash from an all-time high to an all-time 52-week low. And we haven't even gotten the crossover here from the 50-day to 200-day moving average, which you normally get a little bit of a heads up. But I think most of the damage is done. I don't think the stock market's going to go down more than, say, 40%. I don't think it's going to be like the Great Depression or where it goes down 80 or 90%. I don't think the world with its aging population can afford a policy mistake like that. Now, we have basically had an unsustainable financial system for the last 20 years. The cracks showed in 2008 to 2009. They were papered over. The whole fiat system is a complete disaster. But we still live in a fiat system and we play within a fiat system. I am slowly moving outside of the fiat system. I believe in hard assets that have a limited supply, like real estate in good places, like gold, like Bitcoin. But stocks are not a bad place to play, and we will get back to our momentum stocks one of these days. Now's not the time. But if you think it's crazy to buy Bitcoin here, or you think it's crazy to buy gold or buy stocks, you need to carve out a piece of your brain that looks at you and how you're acting and how you're trading and is able to sort of stand outside of all the fear or all the greed and look at what the opposite might look like. And this is what Buffett means when he talks about you got to buy when there's fear in the streets and sell when there's greed in the streets. I'm forgetting the exact quote. So that's my take. I'm still extremely bullish on Bitcoin. I can't emphasize that enough. And maybe it's a sign of impending insanity. But this is the environment that Bitcoin was created for. When there are cracks in the financial system, when the central banks have no choice but to print massive, massive amounts of money. You're going to see quantitative easing like nothing you've seen before. It will not be anything. It will be many orders of magnitude larger than what happened in 2008 to 2009. It's not going to cure the coronavirus, but it's sure going to help to prop up asset prices. And so that's my take on this. Hopefully it was a glass half full take. Bitcoin's very dangerous in terms of its volatility. If you buy this and you put too much money in it, you're not going to be able to sleep at night. You might get stopped out. Fortunately, I sized it correctly, so I can still sleep at night. I can maybe add a little bit to it, and I'm not totally panicking. Though I have to say this was a very, very, very painful day. But we're living in historic times here. This is something that I've only seen days like this. Maybe this is worse than 2008 or 2000, both of which I lived through and traded. This is much more systemic at a more fundamental level. So 2000, 2002, we did have this 9/11 attacks, but it was more a blowing up stock market that had gone from too high PE and was having PE retracement. 2008 to 2009 was very close to the collapse of a financial system. But what we have here is just a complete turning point in sort of civilizational history, where we realize we've put all of our manufacturing facilities, this is the U.S. perspective, we put it all into China. All our medicine is made there now. All our testing kits for coronavirus. And we put a lot of people out of work by doing that. We've gutted the middle class and the working class. And now we have a fundamental problem where a country that we're not on super good terms with has all of this capability. So I think we see a lot of this infrastructure begin to come back to the U.S. for national security reasons. And the central banks will try to paper this over. And it's not going to cure coronavirus, but it is going to help, because you can't have a situation where institutional investors are unable to hold treasuries, where there are these liquidity pockets and people are unable to hold it. So I'm very bullish over the next 5 to 10 years on gold, Bitcoin, real estate. And I also think stocks will do really well from these levels. There might be a further drawdown, 10, 20, maybe even 30%, though I highly doubt it. But if you've had cash and you've been on the sidelines and you have a reasonable investing horizon, you can just go through and you can look at basically consider interest rates at zero. And you've got, Coca-Cola paying 3%, Merck paying 3%, Goldman Sachs, I wouldn't touch them. They're part of the problem. Johnson & Johnson, Home Depot, maybe these sell off more, but there is kind of a limit to how much they can sell off in a world of zero interest rates when they're paying many, many multiples of what you're going to be able to get in a savings account. Anyway, that's my spiel for today. Let me know your thoughts in the comments below, and I'd be particularly interested in hearing your thoughts. What is happening locally? Here in Colorado, I know an MD who has seen many, many coronavirus victims, and this is not being reported in the media, but she's someone who sees these people directly. She's seen 16 new cases every day. And these statistics are not public, obviously. So I'd be very interested in any local color any of you have, wherever you are in the world, what's happening there in terms of lockdowns, civil disturbances, or coronavirus infection rates. Hope you're all surviving this. Hope you're all doing well, staying healthy. And, remember to cherish this time with your family and kids and friends and loved ones, and just stay safe out there. Thanks a lot for listening. Hit that subscribe button and like button if you enjoyed this video, and I'll see you in the next one.